Seema, it's one day. It's one day of a pretty violent move lower on the Nasdaq, and in particular pockets of this market off the back of what we saw in the Fed minutes. Is that one day a flavour of what we can expect in 2022?
I think it gives us an insight into the kind of volatility that we should anticipate going into 2022. You know, we have, of course, we have inflation still very much elevated, so that's pulling through some of the concerns that we had in 2021 right into 2022. And then on top of that, of course, we have all of the Fed moves. You're getting tapering, you're getting rate hikes, and potentially balance sheet runoff all in 1 year. So, of course, this is going to be a volatile year, and I think investors have to be really prepared for the kind of moves that we might be seeing.
Seema, within your very thoughtful note, there's not the idea of a surprise of 2022, which would be a more resilient, higher inflation. Are we changing our probabilities right now, and do we need to game in with a nominal rate move a more resilient, higher inflation?
Yeah, it's interesting with the inflation story. You know, we do see inflation coming down from the levels that we've become accustomed to in the last 2 or 3 months. But at the same time, although it's coming down, we're still likely to see inflation settling at a level which is higher than what we've seen over the last 10 years. Right, so this is a kind of above the 2% target, and it's something that the Fed inevitably has got to respond to. And when we think about inflation, I think from an investment perspective, the key story here is, as you were saying before, it's about real rates. You know, what is happening to that? One of the debates that we have on our team time and time again is, will we ever, will the Fed really permit real yields to get back into positive territory? And how will markets respond? We go through this time and time again. And, of course, recently with this jump up in real yields, it's a question which is maybe getting a little bit closer.
Okay, but let's take it to Principal Global in your institutional clientele. If we get some form of final movement in real yields, even to a lesser negative or even, excuse me, the plague, a positive statistic, Seema, if we get that move, what does it mean for earnings in the animal spirits or corporations? Don't they do pretty well in a higher nominal yield environment?
You know, I'm glad you said this point, because look, when we think about equities, we've got to think about rates, but we've also got to think about earnings. And the outlook that we have for 2022 is still a very solid recovery. It's still a very strong economic environment. We can look at the labor market performance, we look at the demand, the continuous demand, and actually we do see supply constraints easing through the year, so manufacturing should hopefully get a bit of a boost coming into the second half of the year. So with all of that in mind, actually earnings growth stays positive. It's not as strong as 2021, certainly, but it's still quite positive. And against that backdrop, you may not see equities doing extremely well, but we do continue to see positive returns based on that still solid earnings recovery.
Seema, this is the reason why so many people are hiding out in their inflationary stocks, in particular the banks and some consumer discretionaries as well. When do you lean against the mood right now and catch the falling knife that is big tech, especially after hedge funds just had the most violent bout of selling for the past 4 sessions, going back more than 10 years in Goldman Sachs data?
Yeah, so we have continued to hold some of our overweight positions to big tech. We have been really in favor of mega cap tech for a while. We've continued to hold on to that, even as conditions for tech become more challenging. And we have to recognize that, look, bond yields are biased higher. Okay, we don't think they're going to move significantly higher, and this is key because we do see inflation coming down through this year to a 2.5% level. We're definitely not seeing the kind of 5s continuing throughout this year. So we have that forecast. Now, as we're thinking through big tech, we have to think about the cyclical environment as well. You know, the work from home, that kind of thing, it's gone. So actually, the cyclical environment is not in favor of big tech. But from an investment perspective, we also have to think about the long term. And you want to be looking at companies which have got those big balance sheets and can continue to deliver earnings. So we actually still think it makes sense to have an allocation to big tech, certainly not as big as we've had in recent years, but we still think it's an area of defense within the portfolio which makes sense in a year which continues to be challenging. But at the same time, look, mega cap, whether it's growth, whether it's value, I think that's what's key. And with rising yields, it may be that actually very large banks is probably the area that we could see some rotation towards this year.
Seema, can we finish on a tricky one? What would you buy and hold through the rest of this year? The FTSE 100 or the S&P 500?
The S&P 500.